to talk about three things: the seismic shifts that are occurring in the world today, three acts that are going to drive capital, and where we see money going to work. So we'll get right into it. Apologize for a little bit if you can't read that, but Zelensky really summed up, I think, the challenge that the world's facing right now because of not just the war, but the events of the last, I'd say, 12 years since the great financial crisis forward. I think all those events are building up to where we are today. But what he said was, battle can't be frozen or postponed, and he's talking about the fight for Ukraine and Russia, but I think it's a bigger issue than that. It can't be ignored. The struggle will define our world, what world our children and grandchildren live in. And I don't think that's an overstatement at all. I think it may be an understatement. And I don't think we're really focusing on how much the world has changed the last couple of years, even though we're living through it right now. And that's creating some challenges for us as investors. And Mark says, there's a lot I got wrong. There's a reason for it.
Steven, put the mic closer to your mouth there.
Okay, there's a lot going on in the world. So let me get right into it. So I think the three big shifts that we're seeing are this cost of living increase that is not a temporary change. We're in a reset. You think about Social Security went up 11%. The government raised defense spending, the wages for the military, 4.5%. You're seeing wages going up throughout the board. You saw the Walmart increase, you saw other increases. We're going through a higher cost of living around the world, and that's a major change that we have to get used to after being in zero interest rates and very low inflation. The second change is the one that Zelensky was referring to, which is this realignment of the world order around these blocks, whether it's security blocks or economic blocks. That's going to continue, and that is a major shift. It's going to drive capital flows in a way that we haven't thought about before. And at the same time, you're getting this reindustrialization of the global economy, which is playing out, and it's going to create new beneficiaries, and it will really redefine where the investment opportunities lie in our view. I think what's going on for the U.S. is these three legislative acts are driving capital flows and are creating the investment opportunities that we can all take advantage of. Starting with the Inflation Reduction Act, going to the CHIPS and Science Act, and into the National Defense Authorization. These three acts are changing the way business is done around the world and where capital is moving, particularly around the areas of manufacturing, technology, and the defense area. And defense is a bigger topic now. It's also energy, it's food, it's all the different types of security that we need. So where are we putting money to work today? For us, it's industrials and materials that are benefiting from these changes, particularly around defense and infrastructure, and also the energy transition. It's this energy transition where you want to make sure you're owning both the fossil fuels and renewables. And one of the things that's really different is how interconnected these changes and transformations are, because you need the materials and you need the industrial change that's going on to get the energy transition to work, and it's going to require science and technology to make the transition of from fossil to renewables affordable. Same thing with healthcare. We need to get our healthcare costs down. Biotech is a big solution for that. The U.S. is twice what the rest of the world is as a percent of GDP spent on healthcare, and I think it's safe to say we probably don't have twice the quality of care. Dividends are still going to be important because those are the companies that have the strong balance sheets that can continue to pay, and you want to own quality in this environment. It's going to be you want to have the balance of the stuff that's going to give you the returns with the stuff that's going to give you a little bit of ballast in our view. And then we think there's going to be a number of special situations coming out of the dislocations around the global economy and the readjustment of those three big themes that we're talking about that are going to create a bunch of new winners, and it's going to require businesses to reorient their business models. So I'm going to stop there and just leave you with one last thought. The areas that we like a lot in the energy, industrials, materials areas, and industrials, you're looking at the top 5 defense companies have a combined market cap as of about 2 weeks ago of about $526 billion. The top 5 E&P companies at 338 and declining is Chevron just announced a $75 billion buyback. And then you look at the top 5 steel companies, and to make the industrialization and energy transition work, you need massive amounts of steel, and you can buy the top 5 for $83 billion. How many people are overinvested in these areas is the question we're asking, or how many can get that exposure? So we think these are some really interesting opportunities that are not the mainstream. So if you want to make money in this environment, you got to do what other people aren't, in our view. So I'm going to turn it over to Bill.
Thanks, Stephen. Okay. And Bill, maybe you do a better introduction of yourself than I did.
Oh, sure. Anyway, while we're getting the slides set up, I'm Bill Deichler. I'm former Chief Investment Officer for 2 family offices and currently a trustee for a public pension plan locally. So been around in the investment world quite a bit. Kind of a unique background in the sense I've been an asset owner, an asset advisor, and an asset manager. So with those 3 hats on, it's always tough to follow a student, but I will give it a try here. And hopefully I'll hit the right. Thank you. Okay, so in terms of where we've been and we haven't been here for a long, long time is the inflation environment. And the chart that you see up here goes all the way back to 1872. And you can see that inflation was very spiky for many, many years up until kind of mid-century last year, or back in the 1900s. We haven't seen this level of inflation, which is at the far right-hand side of the chart here, for about 40 years. So there are a lot of people out there who weren't even born when we had it. And the last time that we were above 4%, just as an example, was back in the 70s and 80s. And that was a rather long and protracted time. I was around then. I remember going to the store with my mother and actually watching prices change every week. It was a little scary. So right now we're in this peak area of inflation, and taking a closer look, the chart on the left is the CPI, and the chart on the right is the PCE. On the CPI in red, you have the headline, the blue line is the core. So the core is X food and energy. You can see how scary it's been over this short period of time since COVID. The rapid rise, from essentially no inflation to peaking at 9.1%. It's been just incredible, and I think very much a shock to everyone and the markets. Fortunately, we're on the downside of that. Things are coming off rather rapidly. You see almost a V shape beginning to appear. The good thing also with regard to the chart on the right with the PCE, that's the one that the Fed looks at. And you can see that the components, which are those smaller lines down near the bottom, and the overall are coming down rather rapidly. So relatively good news, and the trajectory seems to be holding. Here's an interesting chart from Bank of New York, and this was done probably around July, August of last year. It came out as their 4th quarter report in terms of where do they expect inflation to be going with regard to the consumer price index. So what I did is I superimposed those 2 circles, and you can see that the lower one at the cross point, I need John Najarian's height so that I can get out there and point to the chart so I could actually get it to, and okay, I do have a mouse. Okay, oops, this is dangerous. All right, I'm not going to use the mouse. So anyway, you can see the lower crosshair right there. That's where we are right now, around 6% on the last print. That corresponds to their either something breaks or a softish landing. Hopefully it's going to be more of a softish landing. But we are not at the global recession, which is interesting because for those of you who will be here Monday, I'll be going over the survey that we've done for the community, and it's fascinating to see what the opinions of the community are relative to some of these data points here. So we're not in the global recession, but we're more online with, I'm hoping, softest landing as opposed to something breaks. Taking a look at the yield curve, pretty interesting shape. This was as of earlier this week, but you can see that the short rates are peaking. The curve is highly inverted, and this is interesting. The 10-year is the low point on the curve. When have we seen that before? It's pretty darn rare. And the spread between the 6 months and the 10-year is really in almost unprecedented territory at minus 140 basis points. So you have the significant down. What is this, well, before I get to the last bullet point, what is this sort of telling us is that the market expectations are that we're not going to be seeing the kind of inflation that has been scary that we've seen in the last number of months. Because the further out, if you saw that, the curve would be much larger up. But also significantly is that we are very much still underwater as far as real rates are concerned, and I'll get to that in a second. But before we leave rates and treasury curves, what I wanted to do was give you 4 curves plus today in terms of what did the yield curves look like under various inflation environments. So you can see the green one, which is the oldest, going back to 1988, where the CPI that year was at 4.2%. So we're headed there. We're not there yet, but you can see it's a little bit hard to see the numbers on the side, but the short end of the curve is down at 6.5%. So we are clearly not there. Think about it, 6.5% to just over 9% out of the 30-year normally shaped upward sloping curve at a CPI of 4.2. Next one is down in the blue curve at 2005. There, the CPI was at 3.4. There again, you see slightly upward sloping, normal curve, but definitely flatter and lower. The low point there is at 3%. And then finally, under QE and financial repression, you can see the impact of the Fed actions just tremendously depressing the vast majority of the curve. And also, the vast majority of that curve is underwater with regard to real rates because the CPI at that point in time was 2.2%. So you have to go all the way out almost to the 20-year before you get to real rates of return. As opposed to 1988, you almost had a 200 basis point positive real spread against CPI at the short end of the curve. So now you can see sort of that thin purple line. That is this week's curve superimposed. You can see once again highly inverted. The question that's on the table is, where do we go from here? Are we going to see a 1988 curve? Are we going to see a 2012 curve? I'm thinking we're going to see maybe 2005. So you'll see, again, I wish I had John's height. You're going to see the lower end of the curve coming down, the upper end of the curve going up. And I'm going to leave it to my other colleagues to opine. They probably have a lot better information on that. But you can just see by history where potentially we could have with various scenarios. Again, I'm hopeful for the blue curve. We'll see what happens. So the implication of that, we've seen what happens when you have nominal, extremely low rates of interest, is that it pushes everybody out on the risk curve to risky assets. One could say the same thing about low levels of real rates of return. Same thing. It's going to push investors out to get more compensation for risk for their assets. And Stevens had a great point that we've talked about in terms of the difference, and he mentioned this early on, that if it was like another 400 basis points, it'd be crazy. So, but investors have to think about their asset allocation in these environments, and that the absolute levels of inflation and the rates, not just the real rate, is going to matter because people will perceive it differently, and your movements into what you will demand for risk premiums will follow from that. And so, and maybe further detail is that the cross-sectional risk premiums across assets are going to be different depending upon where rates and how they move. So just wrapping up, I think the demand is going to be much more scrutiny. You're going to look harder at business cases, more demanding analysis, and as Stephen has said many times, you're going to need to pick your spots much more carefully.
Hi everybody, and I'm actually going to express my views here. I'm in a private capacity, not in a Moody's capacity, but I'll bring some Moody's statistics. I just want to make sure that I have a very regulated job. I cannot talk on behalf of my firm. But look, I think I agree pretty much 100%, you said. We're in a very challenging situation, and I think from a both macro political perspective, the China comment, obviously Davos is one. Actually, just to give you statistics, we are pretty much negative for corporates, negative outlook for corporates in North America, negative in EMEA, China very negative, and then the only actually area that we are stable is APAC outside of China. So a lot of what you think about, what the trends that we're talking about, supply chain, issues, etc., are benefiting a lot of non-China Asian countries. These moves, India is obviously one that's taking, is really capitalized on it. You have Singapore, very aggressively becoming in trend. So in terms of the macro shifts that are happening, they're definitely happening. China is having an issue from a property bubbles perspective that has to unwind. They have an issue in demographics. Everybody thinks about the billion plus people in China, but actually the projections are in 20 years, we're going to have more population than China. I'm not sure if everybody's aware of that, but that's the statistical prognosis. So they have a serious issue, and how they're going to land. That's and I'm not a Chinese expert, but I have to be sufficient with my global view, on that. But when you come back to North America, I'm a credit person by training, and I cannot give you investment advice. I'm happy to talk throughout the session in terms of my concerns, and my concern is corporate leverage. Actually, consumer leverage is not a concern. Consumer leverage was an issue post-financial crisis, major one. The consumers have pretty nicely delivered. And I'll tell you statistics that the lowest income borrowers who never had more than 60-day savings, they had 6 months of savings and more as a result of the government support happening on back of COVID. Jamie Dimon, CEO of JP Morgan, on the call 2 weeks ago on earnings call said that there's still savings remaining in the lowest quadrant of the population, but that's going to dissipate probably by the summer. And the only reason I'm mentioning this to you, not that, maybe you're philanthropic, you want to help these people, good for you, but I'm talking more in economic context, what it means for demand. And demand is already weakening. And the lowest cohort, who is kind of your consumer-driven economy, has not entered the job market in a way that we were all expecting, obviously post-COVID. So if you look at inflation numbers, I just looked at the most recent ones as well, slightly different statistics, but broadly, inflation is coming down very nicely in the goods. Energy already corrected, all goods, pretty much agricultural goods corrected. The problem is services. So service is actually very high still. So I'm kind of connecting the dots between the lowest quadrant of trying to get a waiter in a restaurant or hotel services. I mean, we know how hotels have been, one of the upside actually of the commercial real estate side, particularly in the South Belt. So, but the problem is staffing levels. And when the lowest quadrant of the of folks still have savings left that typically never had savings, this crowd never had savings post-financial crisis. Okay, this is the first time these people ever had 3, 6, 9 months of savings was during COVID. That shouldn't happen. I'm not talking in a philanthropic way. We're talking about economically should not happen. It's a distortion of normal kind of Adam Smith type of Adam Smith type rules in the economy. So that's why the service economy is where it is. So we're still running with that inflation. So when the Fed now is looking at, the CPI numbers, and they're looking at that sort of distortion of, we are having a correction here on the goods side and energy side. Housing is still elevated, and service sector, the two areas. Have we achieved the housing normalization? I mean, I bought a place in Naples. How many people bought their second, third home in 2020 or 2021? Can somebody please raise hand? Okay, I bought mine in December of 2020. So my place in Naples appreciated 1.5 times between December of 2020 and June of 2021. Okay, and still 6 months. So it was complete luck, obviously. But that's, I think there's a lot of that, and housing is going to stay elevated. So the Fed is not, if you read through the tea leaves of where the Fed is going to stop, they're going to look at housing and affordability. And they're going to be looking at basically the kind of unemployment mix. And if you think about kind of Moody's view, is that we're going to stop after March at a roughly 5%, 4.75 base rate, and unemployment is going to peak around 4.4% later this year. But if it doesn't, the market has not priced that. So the market has priced 4.7 to 5, and any CPI good story and any good unemployment story, which we've got a lot over the last 2 weeks, the market gets so excited So I would be very wary of what the public markets are doing and what are they, because the Fed is not united. Kind of my job is to interpret what the Fed governors are talking, and there is not a united story there. There is a lot of hawks still in the Fed. And then when you keep that in mind, what worries me, back to the story of leverage, consumer not as much, but the corporate leverage is crazy. And I'll give you statistics in terms of how bad it is. So we have, the typical investment grade corporate before, financial crisis was single A rated. A typical investment grade corporate these days in terms of cohort is BAA or triple B, which is borderline investment grade. So there is a much less cushion in investment grade world, which means much more fallen angels. So if you're in a real money pension fund world that has to invest in investment grade, you have a big risk of fallen angels, obviously much more than pre-financial crisis, which means that when ones have to sell, there's a much more. So that kind of triple B cohort I would be very concerned about, because it's it's challenging. And then what else has changes? A lot of you are in private markets here. The private equities, the alternatives are the norm in any pension fund, in any endowment, etc. And if you look at the leverage, I'm kind of the street expert on private credit. Let me say that. That's the only one thing I would say. And is if you look at the private credit stuff, it was the year of 2021 and 2022 is the year of the biggest growth of private credit we've seen. But if you look at their portfolio companies, and I'm not talking the small ticket stuff here, 5 to 10 million, I'm talking about the kind of up the game middle market, at 6% baseline rate, more than 70% of those portfolio companies have less than 1 times interest coverage. So I'll leave you with that.
You're gonna drop the mic on that one?
Hard act to follow.
Thank you. Thank you, Victoria, for introducing us to Hannah.
So maybe I'll start by introducing myself, since this is my first time here. So Mark, thank you for inviting me. And Mark, if you didn't have me on the panel, I was on the fence about coming, so that was a good. And pickleball was the other thing.
I thought you said you had me at no.
You had me at pickleball,
yeah.
but I was gonna come tomorrow and not today, so you had me at this.
Okay.
But so
you got something to say then. That's good.
Exactly.
There we go.
So I work at BlackRock's OCIO business, which is not very well known for a reason. I think last year in our earnings call, for the first time, Larry mentioned the words OCIO, but it's getting there. I think it stands for outsourced CIO. So look at the consultant model. It's a part of the consultant model where instead of advisory, all you're doing is more discretionary management. For most of our clients are pensions and kind of middle market pensions, smaller endowment foundations, some families that really want to outsource a piece of their book or all of their book, depending on what they're doing. And I think the biggest difference is it's all very customized. So you've seen one OCIO client, you've seen one OCIO client. It's everyone has special circumstances and needs, so you really have to be tailored to them. And I mean, we work with, so I don't know, Mark has been kind of saying this term to everyone, so we work with a lot of asset managers, mostly larger fund managers across public and private, and invest in 400 funds today on behalf of 156 clients globally. So, I think there are a lot of views and that we come across, and we truly look at asset allocation as a very important part of what we're developing. So, from that, I think what I'll maybe talk about is one story, one surprise, and maybe end with an outlook.
This reminds me of how you talk, Jack. You hear this? But watch how she's going to execute it.
So I'll start with one story that summarizes. I didn't hear.
It's okay, keep going.
Okay, I'll start with one story that kind of summarizes what everybody's been talking about in terms of the inflation views. And this is not my story. There is a kind of well-known PM at BlackRock called Bob Miller, who retired last year. And when we did our economic forum, he's basically hired the whole fixed income team, number 2 recruiter. He left with this story, and everybody found it very funny coming from him. Maybe people won't find it funny coming from me. But he basically looked at the room and asked, so how many of you had a gummy? Have had a gummy?
Well, there are gummies and there are gummies.
They're gummies. I think we're talking about the tame gummies. Lots of people raise their hands, mostly the younger crowd.
Carry on.
And so he said, when you have a gummy, it doesn't hit you until a couple of hours after, so you have more gummies. And then, a couple hours later, you're not feeling so well. And, it's not a good thing to do. And he said, this is what the Fed has been doing, and this is what central banks have been doing. They took a gummy, they raised rates. They were called out for being behind the curve, so they raised rates again. And now you're starting to see the effect, and now it's all kind of coming, too much gummy. So, look, I think to the point that Bill was making, you're starting to see PC inflation down to 2%. And Fed has no reason to continue on the path that they have, but, part of their challenge is building credibility and managing expectations. So you could see them continue on this path just so that they are seen as credible for any future inflation. But at this point, from what we know they look at, there is no reason for them to. And I think that leads to, I think the kind of biggest, so one of the other things that I'll talk about is we have started using GPT and ChatGPT to summarize a lot of the manager views that we get, considering that we're looking at 150 managers. One of the themes that came out was invest in bonds, invest in fixed income, and the kind of that as an asset class has really not been on people's radar. So from an asset allocation standpoint, we're really saying, look, 40-60 is the new 60-40. Look at areas of fixed income like structured credit, the areas that have really been ignored, right? So even looking at kind of the public-private, like Anna mentioned, high-yield bonds are yielding 8%, and private credit, So you kind of have to look at the delta, and at a time when for a lot of investors, they really kind of needed the liquidity last year when, if they over-invested in private markets and got capital calls and then had to sell at the wrong time or go into secondaries, people have realized that there is a cost to not having liquidity and are going into liquidity. And I think in terms of the surprise, so that was the story. The surprise to me has been, I was really expecting private equity and VC valuations to have come down a lot by now. But I was looking at the Goldman study that came out on Q3 numbers, and private equity valuations are only down 2-3%. VC growth, slightly more. But in a year when global public markets were down 25%, that's not a lot. So, if you're going to have a soft landing, I don't really see that kind of recessionary expectation where valuations would come crashing down on you to really be realized. So that makes it quite an attractive asset class. And one area that we're looking at is the whole spectrum of public-private funds. So within, credit and fixed income, there's a lot of multi-sector funds that are coming to market. Within equities, we're seeing a lot of public-private funds that are trying to capture the whole spectrum instead of making investors choose the allocation. And then in terms of outlook, the last thing I'll talk about is emerging markets, since we touched a lot on the US. When I was at the, last year I went to my first IMF annual meeting after 3 years. And, oh great, well next time we should coordinate. And David Malpass, who's such an amazing speaker, and I saw him there, really kind of talked very passionately about the cost COVID has had on emerging markets. So their debt servicing costs have gone up because of rates and inflation. Having a strong dollar has been punishing, and they were really affected by COVID, and the recovery hasn't really been that smooth. So I am very bullish on emerging markets with weakening dollar, and the fact that even despite the fact that these kind of triple threats really should have damaged emerging markets more, there's really been resilience in that space. So, and you're starting to see, I'll call out, I grew up in India, so I'll call out India. That's one area that's really a bright spot where, with kind of a lot of investors getting out of China, they're looking for alternatives, and India is really emerging as that alternative in terms of its inclusion in broader indices and in the recognition of kind of the demographics as well as the more capital-friendly policies that the government has. So my outlook really is, invest in India if you're looking at country investing, but emerging markets as a whole are going to have a good year.
What do you think about China? Let's talk about China.
Me or somebody else?
You.
So, I mean...
I'm over here.
Yeah. I was like, did the question come from here? It's echoing.
Sorry.
Look, China is going to have the impact to the markets that you've seen from the reopening, that trade is already done. So it is faster than expected reopening, but most growth expectations for China are lower from here on now. And if you look at kind of the competitive advantage that China had, in kind of in semiconductors or supply chain, I think with the policies that the US is enacting in the Semiconductor Act, that's going to be eroded. So I'm kind of struggling to see what really is the growth driver for China, that keeps it at the level that it has been the past 20 years. And other markets are going to come in and try to supersede that. So I don't know if anybody else has anything to add, but I'm not as bullish.
We were very negative in China this year, and we still have negative outlook, but actually the most recent reopenings revised our economic projections up. So I think around 5%. It used to be 3.5%, it's around 5% now. But they need 6%, as we know.
But long term?
For 2023.
What about long term for China?
I'm just going to say my personal view. I'm long US.
The tilt down here in me. Here we go.
Apart from India, which other country in Asia do you find, or Africa, do you find attractive?
I'm not a country expert. India was my personal view, but if I think I would say regionally. So regionally, definitely parts of LATAM, kind of Southeast Asia are definitely attractive. So, I would say we're kind of staying away from Eastern Europe still in terms of there are a lot of headwinds and like unknowns in that space. But within Africa, there's definitely a lot of opportunities. I'll have to come back to you on the specifics. I don't have them off the top of my head.
Yeah, I would agree in terms of Asia ex-China, Southeast Asia, really interesting, especially with all the nearshoring that's coming in, or the friendshoring. I think hopefully you all didn't miss the import of Anna's statement with regard to the demographics in China. It is a huge, huge thing. It hasn't reared its ugly head just yet, but it's coming. But in the meantime, I think that if she can navigate himself back to the kind of environment pre-COVID, where there was just tremendous amount of entrepreneurial spirit going on inside of China, if he's going to allow that to come back, then I think that there's a great case to be made. But in the meantime, I'm cautious there.
Yeah, I think how China re-engages with the rest of the world, with US and Europe, is really the swing factor for the global economy this year. And it's off to a start where they need the economic activity, so looks like they might be more friendly towards and more open towards it. That's what you're hearing with Yellen and her counterparts. So I think that's a big swing factor that's going to determine where we go from here. The reopening has helped the US and Europe considerably navigate this start to the year, and I think that's one of the big surprises for me as well. It was hard to time how she was going to exit and what the implications are going to be, and I'm quite frankly surprised that we haven't had more infections that are crippling and maybe leading to lockdowns, but I don't know if he can lock down again. So I think that's going to be a real challenge. But like Europe, they've benefited from the warmer weather and the lower energy prices too, so that's going to help them.
So if you remember our lunch, and we do a Thursday lunch in New York, whenever I'm in New York, it's 3 times a month. There was a bull case made that she did all this for politics. He was supporting certain things, Russia, beyond that. He could shift. He's providing this outreach to Australia and the U.S. because every year, what's the, because it was 2020, with the new president coming in, we have this report of the scenarios. There are 5 scenarios. By the way, Stephen, before the war in Ukraine, you provided 5 scenarios. We said there's no way that Putin actually attacks. We have black swan, white swan deep dives coming up, by the way, and one of them, you can't see it, but it's China-Taiwan. Does China, what happens? Who's the best, who are some of the best people to know that? But Japan has doubled their military budget. Korea, we are more aligned, NATO, than ever before. The bloc has formed. We said there could be enlightenment or blocks, and here we are. Kissinger was right. We're in blocks. But quantum computing, $100 billion from China versus our meager amount, ChatGPT and all that. So there's interesting dynamics, but we're in Naples. I'm going to shift gears. Are we on? That's our first. That's our the press for Rob Colorina is going to ask. But I want to switch to Naples in a second. But go ahead, Rob. I like interaction. Go.
Thanks, Davika. To the extent you could comment, just generally on ESG, just given the dynamics with BlackRock and some of the sort of the major asset managers on the ESG treatment allocation from some of the a couple of the large state pension funds. How is that dynamic changing the directional mandate by you all? And also, I was at something earlier this week that one of the northern managers commented we wanted to stick to sort of the BlackRock position and with a letter. And then just a quick follow-up, Steve, I think that's the first time I've ever seen distress on one of your slides. Are you guys, is that distressed debt, or are you guys looking at distressed equity?
Actually, it's really a reflection of the distress that Anna was talking about with corporate credit. I think corporations are in 2 camps, and most of them are in the camp that she was referencing at 75% got way over their skis. And this interest rate move, as bad as it is for governments, if you're a company with high debts, that 4% change could be deadly. So I think that's going to create distress where they're going to sell off units, and that opportunity to pick up stuff for the companies that are sitting on cash is going to be a big opportunity.
What's the average duration of that corporate debt?
Typically it's a 2.5 years average duration.
Yeah.
But if you think about it, a single B corporate that had to go to market, very few of them. By the way, to give you a sense, the leverage finance market was the worst year ever since 2007, 80% down issuance in 2022. It's a slow start for 2023, so it's not going to, which means the private credit is still going to have a pretty good year for the beginning. The problem is going to be that people, firms who had to refinance, who are in the single B or worse cohort, they refinanced at 13.5%. Deals were done at like 11, 12, 13. So if you were able to, and again, it goes back to the picking the right assets, cash flows, was it a structural problem versus something that's fixable that you can outsource and kind of beautify it? I mean, you have to be a credit picker here, but it's very ugly. And the problem is going to be that, I think, you talked about sort of where PE is now and the valuations, and it hasn't corrected at all. But if you look at Blackstone's results, they just published results this week, they're down obviously on the private equity portfolio, 5-10%. But that is, people are saying, are those valuations even still realistic? The reason why the leverage finance market is not functioning is because they can, I think there's a 20 to 25% difference in valuations between buyers and sellers. And they've closed it by 5 to 7. So there is a way to go here. And I think this is where the opportunities are going to be.
But the question was originally to you.
I can answer on the ESG question. So I would say, from a ESG investing standpoint, there are kind of 2 threads. One is, you kind of look back and realize that if your strategy was essentially about investing X energy, then you're really driven by the energy market. So you kind of see the cyclical performance of your ESG portfolio just be driven by where the Bloomberg commodity index is. And so last year, a lot of sustainable strategies, so-called sustainable strategies, really haven't done well. and that's kind of been the entire factor because they are, no matter what fancy way they have of computing sustainability, that's essentially what they're doing. The other side that I think is the shift that's happening is so I was actually at a Milken Institute conference early January, which was entirely centered on the Infrastructure Reduction Act. And they actually had somebody from the Florida state government on the panel who was quite bullish about the Infrastructure Reduction Act and the kind of impact that it'll have on clean energy sources. So there's a lot of investment that's happening or could happen in the U.S. To the extent that Europe is looking at it and rushing to pass, kind of their version of that. In order to kind of really spearhead renewables and clean energy tech. So I think that space is really going to explode and really go beyond solar and wind, which has been kind of the focus. So you're going to see more new technologies and new ways of accessing energy sources, because really, that's kind of where a lot of the geopolitical events, at least in the last year or so, have centered around. Kind of the price of gas for Europe and kind of Russia exporting some of that to Asia, kind of making kind of the energy dependence as something that everybody, no matter where they're on the political spectrum, is something everybody's focused on. So I think that's kind of the but outside of that, there is just so many views, right? So there is a schism, and how we get out of the schism and the political divide is kind of secondary to, well, what are the solutions? Where are the investors going? I would say like a lot of the investing is happening from investors outside of US, so mostly Canadian pensions and European pensions. But you are starting to see kind of more, interest, at least in the US, in terms of kind of what are these spaces that are attractive.
And to that point, on Monday in Miami, we have some pensions, their perspectives on how, because they have a mandate, to your point. It's more than an interest. Now, Europe has a mandate, no fossil, 2035. We'll see how that goes. But I just flashed on the screen. But we were in Naples, and I wanted to get the zeitgeist of Naples. And Cheryl, you were here last year. I think she said in 2021, to your point, Anna, the number of new Florida residents, I know it was like, I want to say 600, 700,000, but I'll give you the...
Well, in Naples, only the school system, by the way, Naples is not a fun place to live if you have small children, but even with that fact, 7,000 new, what I heard was...
I might differ with you.
Well, we like difference.
Okay, no, in the number or the fun place to live?
In the what?
In which, what would you do? In the number or the fun place to live? I heard 7,000 applications for the elementary schools in Naples.
Oh, yeah, I thought you meant the quality of the schools. I thought.
No, the quality of schools are phenomenal.
They are.
What I'm trying to say is that people have not considered Naples as a retirement community. It's not been considered as a living with kind of middle school children, which I have. But there are 7,000 families that moved in during COVID in kind of the public school system.
Well, we went from an average age of 64, I think it was, to 42 in 4 years. So the average age has taken, the infrastructure can't possibly catch up with that.
So last year, Cheryl hosted us, because they're a development company, really has their fingers on the pulse for many years of Naples, and things, your graph probably, Bill, those spikes, Naples had a spike here, not just Naples, but have you seen it this year?
Well, by the way, I'm Cheryl Deering with John R. Wood. I see a few familiar faces, I'm not sure. John R. Wood, Christie's International Real Estate. This year we hooked up with Christie's, which is reinventing itself after 250 years. So they waited until I got to be that age so they could do that. In any case, this year we've had a COVID variant. We've had the worst labor shortage we've ever seen in a town that is based basically on real estate. We have supply chain issues, which are still out there, not quite as bad as they were 2 years ago. And then somebody said, let's give them Ian. So we got hit with this nice hurricane in September 28th, and the world pretty much came to a stop from there until just about the end of the year. For example, John Arwood Real Estate is the #1 real estate company in the southwest region here, basically Lee County and Collier County. And so we went from, in 4 years, we went from 2.8 billion in sales to 3.2 billion to 5.8 billion in 2021 to 4.2 billion last year, because we had that last quarter that was kind of taken out, took our feet out from under us. So the growth is unprecedented. I've been here since 1985, and I thought we saw a lot of growth since then. But we basically, 2 years ago, didn't have much more land to develop in Naples or the greater Naples area. So we all started moving north into the eastern section of Fort Myers. You might have heard of Babcock Ranch, which has, I think, 15,000 homes, and they're a green community with solar, and they've been in national news because they survived the hurricane so well. A lot of us did, by the way. The beach communities obviously got wiped out pretty badly. But going north, and as we all were moving north, we're up into Charlotte County now. John R. Wood went from 6 offices to 26 offices in 3 years. 5 of them got wiped out. They're back online already. Sanibel, Pine Island, some of the outer islands. So that's kind of the history of just dollar figures. We always do well when the stock market goes down. This year and last year we did well, and the stock market was continuing to go up. I mean, it has fluctuated. You guys know that market a lot better than I do. But we still have probably, and this is anecdotal, I don't really know, but somewhere between 60 and 65% of our sales are cash sales. So it's really hard to understand what the rates are doing to us. I know what they're doing in some of the lower end developments that I have. I run the new construction division, and there aren't a lot of new construction developments in Naples and the greater Naples area because there's no land. So, but with Ian, everything has been revived in this area because a lot of the properties are now being torn down. They're either torn down or the properties are being rebuilt. We're having major governmental issues because there are laws about you can't rebuild at the same elevation if you're rebuilding more than 50% of the home. The value of the home, well, the home values are not there. The land is the value. So it's really kind of out of whack, and it's becoming a big issue. So I have 3 developments down here that I currently take care of.
Can I ask a question from a kid from Ohio? What the governor of Ohio tells us is that if you really need people, like you mentioned,
Labor.
They have to commute an hour away.
Worse than an hour.
It sort of hits sort of the sort of the part of the economy that's not quite included in all this. And is there and then we have no immigration. Put that to the side. Is there how are you solving for this?
Well, it's not being solved fast enough.
In an equitable
Yeah.
way.
The local officials will continue to say, we need housing, we need housing, we need housing, and then they will continue to get worse at putting up obstacles in front of developers so they can't do housing. And that's exactly what's happening. It's still happening. We have our labor pool for South Naples. We have a development halfway to Marco. Our labor pool comes from Punta Gorda and Lehigh Acres, which is probably an hour and 45 minutes. They no longer have to come and work on our site because there's 26,000 open permits in Lee County. So they can stop in Lee County and work on the construction for probably twice the amount of money because they're working with insurance checks. So we have a site that usually has 30 or 40 workers on it any given time. The other day we had 3. We can't get them built, which means My sales are 53 sales ahead of construction, which means we're going to end up underwater because the materials are going up and we've already sold at a price. So it's serious. Yes, sir.
Last year, I asked the question about cash buyers versus not. Has that changed much? Even 65%, I don't think was the number you were quoting last year for down here.
I personally think it's gotten higher in cash buyers. We have an awful lot of people, and this really is anecdotal, in the high end. A lot of people at 65, 70 years old, 60 years old, actually it's getting younger, buying properties for their kids that just got out of college that don't necessarily have jobs. So all of a sudden, the $600,000 and $800,000 market, which is considered our mid-range, that market's being eaten up by those people parking money, and it's probably estate money, but they're spending it now. And like I said, we're not seeing a lot of, and without PERS approval and Fannie Mae, which they've also made more difficult, it's difficult to do a lot of sales that aren't cash. So.
Can I ask about
Sure.
the high-end Rosewood?
Yeah.
The Four Seasons, the Rosewood, starting price 14, 17 million.
Yeah, those are all gone.
All gone. Well, is there more room for those kind of properties?
I would have said no.
Naples market.
Yeah. We actually walked away from that project to begin with because we still believe it's better to be the second agent in, not the first agent.
Yeah.
But there have been reservations on that property. There's been a couple of contracts, and the city has now opened up their permit. They're giving them hell. They're still giving them hell. So they're under construction with a full permit and full site approval, and after the hurricane, the city has now, and they're in the city, the city has now said your drainage wasn't good enough, and they've held up some of their construction. It just...
So if you are a high-end buyer, okay, and you didn't buy the 17 million to wait for 3 years, it's
Right.
like 4 years now.
Right.
Do you think it was a good decision? Because that's going to be resell at 15.
I don't think the high-end buyers that are in those sales are the ones that are going to end up closing on them. I think they'll resell them, and that's happened before.
So where are we going to resell it?
Where are they going to go?
They'll go to the new stuff that's being built. We didn't expect to have anything. So now, Coquina Sands Moorings, downtown Naples, there's a lot of things that are being knocked down. A developer just bought 2 mid-rise 1980 buildings on the beach. I don't know how he assembled everybody, but everybody had to come to the same decision to sell. And I think there were about 50 people in there. Bought them for $52 million for the land. For 2 small
so
buildings.
if you're in the market for ultra high net, like high property on the water, do I wait?
This next year, I think 24 is going to be a huge year. 23 is settling out. Yeah.
I have one more voice of the Naples family office community. You've heard all this. What are your thoughts?
Well, I was going to switch gears, actually. I'm Barb Quashis. I was 27 years CFO for the Terry Kohler family up in Kohler, Wisconsin. You might recognize the name from your toilet bowls, or having golfed at some of the fine resorts. Sure. I was an enterprise gal. That's how I met the Kohlers. Head of students in enterprise. I studied accounting, international business, and Spanish. Had a fly at Fly Fisheries Art in Chile, and we grew a global sailing brand, North Sails, the engine above the deck, Southern Spars, New Zealand, the rigging, Terry's MIT grad, pushing them, and retired Air Force captain, so always pushing the envelope on technology, peoples, and process, so that's what we did. And so I was the second-hand gal behind this great entrepreneur, making sure his blind spots were covered, because he moved very quickly. But having had that experience, we sold the sailing company to a London-based firm back in 2016. I worked with the family as well to develop the next gen. Governance, very important for free enterprise. Those of you that are trying to buy family health businesses or work in a family health business, it's not easy. And people think if you have wealth, it's easy, but it's not. So I love to support the families that are creating the wealth for the investments that all of us want to buy. And I am long US with you because I believe in free enterprise.
Are you long Naples?
I am long Naples because I moved here 2 years ago, and I now work for a multifamily office called Crescent out of Chicago. But we have a trust company, and so I come along entrepreneurs. We fill in as a family CFO wherever space is needed. We come along people who are already professional investors.
But do you think Naples is innovating? Is there innovation?
Okay, so this is where I'm coming. So, Free Enterprise Gal. I was just at a Next Gen. They do presentations where they bring in people who started companies, speaking to FGCU, who has an entrepreneurial center. And so this area, what I love about it is, I call it the 1% of the 1%, and I'm the service provider to these 1% of the 1%. Because they call themselves previously important people, because if you can afford to live here, you've done well someplace else. But the lovely thing about the people that move here and make this their community, lovely, quaint as it is, though dealing with schools and traffic and house prices and service workers, they need the Americans Club that, like Kohler had, that supported these people, and now it's a 5-star resort. That's kind of what they need here. But these entrepreneurs, previously important people, want to give back to this, to the world, to Naples, and they all are eager to help and share what they've learned and done. And FGCU, there's an entrepreneur center, so we have people who come in there, we have speakers, there's mentors. These people want to be involved, and they're also very philanthropic. We have upcoming next weekend, the Wine Festival, which raises money for all the Immokalee students of the underprivileged. They raised $23 million for this event last year, one weekend. And this is one of many, many, many galas and philanthropic events. I love Phil Wood. I actually spoke at your event, and great companies, just people who give back, people talk about impact investing. I'm like, family-held companies, privately held companies is impact investing. You're creating a community, you're creating jobs, you're creating schools, you're creating fine restaurants. The arts here are amazing, what it can offer. I always said, if I can support that is impact investing in many ways. So it's a lovely community. There's a lot of entrepreneurship, great ideas, connectedness around the world, the network. We all know it's about good people connecting good people.
In a nutshell, Palm Beach, Miami, Naples, there are 3 words to describe each of those cities. What would the 3 words are for Naples?
Yes.
Ooh.
Midwest sensibilities.
Okay, that's good.
That's
Being
good.
from Ohio, doing Midwest tours. Well, look, any questions to this esteemed panel? Yes. How's your foot, Andrew? Your ankle. It doesn't work? Okay.
It's a Naples question. I'm not really sure. I'm not really sure who to answer it, so you'll have to decide. So the numbers going up in sales, appreciation obviously can do that, but the age dropping, children going to school, isn't just numbers that way. So walking down the street, restaurants full, all great. What is missing that needs to be done? Schools, what's
Labor.
not the 1% of the 1%, leave those people out because they can do anything they want. What's missing?
Labor, schools, and infrastructure. And the labor, you'll notice that some of the restaurants are packed solid, but half of the restaurants closed. They can't get the labor. Yeah. And that's been a phenomenon since June, before Ian. Ian made it worse. We've lost a lot of labor to South Carolina and to Texas. So without the infrastructure, soon the 1% of the 1%, and she's absolutely right, doesn't want to be here if they can't get service. What's the labor what?
What's the labor priced out of the area?
The labor's not priced out of the area. I'm sorry? The affordability, yeah. We have one development that's 54 villas starting at $389, which is the cheapest thing in town. And that's okay, but the county has shut it down over and over again for stupid little things, excuse the expression, like you didn't have your silt fence, you had only one.
We know why it's being shut down.
I'm sorry?
We all know why it's being shut down.
Yeah.
I mean, it's playing defense for certain classes of
well,
people.
yeah, maybe.
So let's
I
pause.
think it's probably
Stay-
inadvertent. I mean, I've been here since 1985, so a lot of things have changed, but we've always had the 1% of the 1%, but we always were able to service and have the infrastructure of the roads. We've grown really fast. We've had 600,000 people this year. They're predicting 8 million people coming to Florida, with half of them to Southwest Florida by 2030. It's not very long. Now, Charlotte County has land, and it's starting to build up.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.